Welcome back, finance students. I am absolutely thrilled to have you here for today's explainer. We are mapping out something truly monumental. We're going to trace exactly how BlackRock transformed from a super niche risk management startup into a global hegemon that literally has its sights set on dominating a $68 trillion market. But before we get into the history and the strategy, I want to hook you with a question. Who really owns the bloodlines of modern civilization? I want you to seriously think about who truly controls the physical infrastructure we rely on every single day. You know, the water flowing from your tap, the electricity powering the screen you're looking at, the airports you fly out of. It's a pretty fascinating question, isn't it? Okay, let's dive right into this. $68 trillion. That is the staggering amount of capital that's going to be needed for global infrastructure by the year 2040. And BlackRock, under the leadership of its CEO, Larry Fink, is aggressively positioning itself to completely dominate this exact space. But to understand how a single firm can even attempt a play this massive, we have to understand their blueprint. Here's our syllabus for today's explainer. We'll start with the architect of risk, tracking Larry Fink's early Wall Street career. Then we'll look at Aladdin and systemic dominance, the shadow government playbook, the ESG marketing illusion, their massive pivot to privatizing global infrastructure, and finally, we'll weigh the ethics of absolute monopoly. All right, Section 1, the architect of risk. To really understand BlackRock, you have to understand the psychology of the guy who built it. Larry Fink wasn't born into Wall Street royalty. He was the shoemaker's son from California with just an absolute obsession for success. Let's walk through this timeline. Back in the late 1960s, Fink was at UCLA, shifting his focus from political science to real estate and high finance. By 1976, he steps onto Wall Street, joining First Boston as a bond trader. In the 80s, his star rises incredibly fast. He becomes the youngest managing director in the firm's history by pioneering these wildly complex securities. But then disaster strikes. In 1986, heavily confident that interest rates would rise, he placed a massive bet, but rates plunged. Because of a single devastating numerical miscalculation on his hedge, essentially an insurance policy that was meant to protect his trades, his department lost $100 million. He was mortified, completely ostracized, and ultimately pushed out of the firm. The specific product Fink helped invent right before that spectacular fall was the mortgage-backed security, or MBS. For you finance students, think of an MBS kind of like a financial casserole. You mix a bunch of individual home loans, bake them into one product, and slice it up to sell to investors. At the time, it was the ultimate diversification tool, right? Just the perfect fixed income instrument to monetize the American dream. But as the world would painfully learn later on, it carried massive, hidden, and deeply contagious risks. Moving on to Section 2, Aladdin and systemic dominance. That traumatic $100 million failure literally rewired Larry Fink. He vowed to become the absolute master of risk management. His secret weapon? Aladdin. It stands for Asset, Liability, Debt, and Derivative Investment Network. This computerized system became the absolute beating heart of BlackRock. It could run instant what-if risk simulations, like what if interest rates rise 1%? What if mortgages in California default? Aladdin embedded rigorous risk modeling directly into every single investment decision. It was so effective that during the infamous Great Bond Market Massacre in 1994, while the rest of Wall Street bled, BlackRock totally sidestepped the worst of the carnage. And that intense focus on risk paid off exponentially during the 2008 financial crisis. You remember those mortgage-backed securities we just talked about? When they collapsed the global economy, Fink was ready. While all his competitors were drowning in toxic assets, BlackRock had kept its exposure low. Fink turned that sheer panic into pure opportunity. He swooped in and acquired Barclays Global Investors for $13.5 billion. This masterstroke gave BlackRock ownership of iShares, instantly making them the absolute kingpin of the booming passive ETF market. You know, funds that simply track an index rather than picking individual stocks. But it wasn't just brilliant acquisitions. Because BlackRock understood the toxic assets better than anyone else, the government came knocking. In 2008, U.S. central bankers tapped BlackRock to literally draft the playbook to rescue the financial system. Fast forward to the 2020 COVID-19 crash, and the Federal Reserve again hired BlackRock to manage its massive bond-buying programs. What we're seeing is global central banks essentially outsourcing their crisis response directly to BlackRock's proprietary software. When the world ends, Wall Street calls Aladdin. Section 3, the shadow government playbook. So the crucial point is, with so much power consolidated post-2008, you would expect massive regulatory oversight, right? Well, look at their primary defense strategy, passive investor status. After 2008, the Dodd-Frank Act branded major banks as systemically important financial institutions, basically slapping them with the too big to fail label, subjecting them to brutal regulatory oversight and heavy capital requirements. But BlackRock launched an unprecedented lobbying blitz. Larry Fink even personally met with President Obama. Their whole argument was, hey, we aren't a bank. We just passively manage other people's money. We don't hold the risk. And it worked. They successfully dodged the label, carving out a massive loophole that protected them from strict capital reserves. They maintain this level of protection through what critics called the revolving door. And it's an astonishing two-way street. BlackRock has hired at least 84 former global regulators, central bankers, and government officials to help navigate and soften oversight. Meanwhile, on the flip side, former BlackRock executives are regularly placed into high-ranking public offices. A really striking example is Friedrich Merz, a former BlackRock executive who became the Chancellor of Germany. We are looking at a system where a single firm can effectively help shape public policy from both sides of the fence. Section 4. The ESG Marketing Illusion. By the late 2010s, facing immense pressure from activists who are labeling them a climate villain, Think completely rebranded BlackRock as the champion of environmental, social, and governance, or ESG, investing. But was it genuine moral capitalism? Well, a former BlackRock executive turned whistleblower, Tariq Fancy, gave us this incredible quote. He said ESG was essentially taking the thing you had, painting it green, and then putting it out there and putting a higher price tag. As passive ETFs became totally saturated and management fees dropped across the entire industry, slapping a green label on an ETF was just a brilliant way to justify charging investors a premium fee. The tension here between BlackRock's rhetoric and its reality is striking. While Larry Fink was publicly demanding CEOs go green or face the consequences, BlackRock still held massive fossil fuel assets. While championing social governance, they simultaneously held billions in defense contractors like Lockheed Martin and Raytheon. This obviously sparked fierce criticism from all sides. Environmentalists called them complete hypocrites, while conservative politicians accused them of pushing woke capitalism and sacrificing retiree returns for political ideology. We aren't taking sides here, but it is absolutely vital to see how their moral posturing clashed directly with their actual investment outcomes. Eventually, that political backlash just became too costly. Back in 2020, BlackRock supported nearly half of all ESG shareholder proposals, but by 2024, that support cratered to just 4%. Faced with states like Florida pulling billions in assets, Larry Fink quietly retreated. He even stated publicly that he was ashamed to be part of the ESG conversation. When the profits and the PR dried up, BlackRock simply moved on. Let's dive into Section 5, Privatizing Global Infrastructure. Let's move to and see how this all builds, because the era of abstract indexes and ESG hype is officially over. BlackRock's new endgame is highly tangible, essential, and fiercely monopolistic. In early 2024, they acquired Global Infrastructure Partners for $12.5 billion, aggressively targeting regional monopolies. Think about it. You can't opt out of using a local power grid or the Panama Canal ports. They're even positioning themselves as the primary gatekeepers for post-war reconstruction in places like Ukraine and Gaza. It's a move critics warn could heavily destabilize recovering nations by prioritizing corporate extraction over local rebuilding. This is a cold, calculating financial maneuver to own the actual physical bloodlines of global trade. For you, finance students, pay close attention to this. The key to making this work is the catalytic capital strategy. This is exactly how BlackRock de-risks these massive physical investments. Step 1. Target distressed or post-war infrastructure. Step 2. Convince public institutions, like the World Bank or national governments, to guarantee the capital. Step 3. Extract long-term private profits while the public taxpayers hold the actual downside risk. It is quite literally the absolute dream scenario for an asset manager. Which brings us to our final section, number 6, Ethics of Absolute Monopoly. We really need to look at the profound societal risk here. What actually happens when private, profit-driven firms take control of vital public services? A highly dangerous dilemma emerges between profit expectations and public maintenance. BlackRock secures these 30-year contracts to extract steady dividends. But what is their incentive to actually improve the system in year 25? Often, there is absolutely none. Just look at the privatization of the UK water system. It led to crumbling infrastructure, massive pollution, and skyrocketing user fees. When the only motive is the continuous flow of money, the public interest is almost always the very first casualty. Which leaves us with this final, provocative thought. When a single private firm, armed with unmatched technological dominance and a revolving door of political influence, begins to control the world's most essential services, who actually protects the public interest? I really want you to take that question with you. Thank you so much for joining me for this explainer. Keep analyzing the systems around you, and I'll see you next time.